the current real estate market is facing challenges including rising interest rates, high inflation, and a shortage of housing inventory. These factors have led some experts to warn of a potential storm brewing in the real estate market. The combination of these factors has led some experts to warn of a potential storm brewing in the real estate market. Experts like Barry Sternlicht believe that the market could see a decline in prices and an increase in foreclosures in the coming months or years. Welcome to Nova Society, where money magic happens. If you're not already in the loop, become part of our community today. Real estate market. Sternlicht is also involved in a non-lodging business. Currently, he is widely recognized as one of the foremost real estate investors in our nation. At present, there is a prevailing belief that the real estate market may face challenges due to the impact of high interest rates, which are progressively causing greater difficulty for individuals in meeting their loan obligations. Consequently, there is a growing concern about the potential increase in loan defaults. Here is his perspective on this matter.
We're going to have a lot of defaults soon. What do you think about that observation?
Anything with a fixed income stream is worth less when rates rise. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape.
Real estate values and interest rates. To gain a comprehensive understanding of the real estate market, it's essential to grasp the connection between real estate values and interest rates. Real estate is classified as an asset with a fixed income stream, which represents a reasonably predictable annual cash flow. For instance, if you own an office building with a tenant under a 10-year lease, you can anticipate a consistent rent income over that period. These guaranteed cash flows are what constitute the fixed income stream generated by real estate. When Barry Sternlicht mentioned that any asset with a fixed income stream depreciates as interest rates rise, he was referring to the impact of interest rates on real estate's worth. To illustrate this concept, let's consider the example of owning a small apartment building. Imagine you own an apartment building that yields $100,000 in cash per year. This annual income stream consists of rent earnings minus various expenses, such as maintenance, property taxes, management fees, and leasing costs. Assuming a 5% annual increase in cash flow, you plan to sell the apartment building after 5 years. In commercial real estate, a property's value is determined using the capitalization rate, cap rate, which represents the property's yield over a 1-year time frame when purchased entirely in cash. To calculate the apartment building's value at the end of 5 years, you can use this formula: divide the net operating income, the cash generated by the property, by the cap rate. This straightforward calculation yields the property's worth. Now, to determine the current value of the apartment building, you must discount the expected cash flow over the 5 years back to the present using an interest rate. This concept is known as the time value of money. Applying a 6% interest rate in our example, the current value of the apartment building is approximately $2.28 million. However, as interest rates increase, the property's value decreases. If we raise the discount rate from 6% to 7%, the apartment building's value falls to around $2.18 million, a decline of about $100,000. This decline is because higher interest rates reduce the present value of future cash flows. Moreover, increasing interest rates also affect the property's cap rate upon sale, as investors demand a higher return on their investment. Elevating the cap rate from 5% to 6% further reduces the property's future selling price. Consequently, with these higher interest rates, the current value of the property plummets from $2.18 million to $1.89 million. This scenario highlights the significant impact of interest rates on real estate values. As interest rates rise, the worth of real estate assets can substantially decline, even if the underlying cash flows remain unchanged. Currently, the real estate market fundamentals, represented by the cash generated by properties, remain robust. However, this favorable outlook is expected to change shortly, according to Sternlicht.
Well, I don't know what to say, except it's Christmas and we're all in misery.
Supply and demand. Real estate, in economic terms, falls under the category of commodities. The price of any commodity is influenced by the prevailing supply and demand dynamics at a given moment. To illustrate this, let's revisit the example of apartment buildings mentioned earlier. As previously discussed, the value of an apartment building is closely tied to the income it generates. However, what determines the rental rates that owners can charge for individual units? It's the interplay between supply and demand within the specific real estate market. Consider a supply and demand graph. On one axis, we have the supply, which represents the number of available apartment units in a particular area. On the other axis, we have demand, signifying the number of individuals seeking to rent an apartment. The point at which these two lines intersect represents the price, in our context, the monthly rent for apartment units as determined by building owners. In a scenario where fundamentals are robust, demand surpasses supply. In recent years, the economy has shown remarkable strength, with low unemployment rates and substantial government stimulus programs. Furthermore, soaring home prices have compelled many potential homebuyers to opt for renting, boosting the demand for apartment units. This increased demand shifts our demand line to the right, resulting in a higher rent price. The elevated rents, in turn, enhance the income generated by apartment buildings, making them more valuable. However, conditions can easily take a downturn. During a recession, demand for apartments can decrease as job losses prompt individuals to move in with family members or seek roommate arrangements to mitigate rent costs. Some existing tenants may face financial hardships and may have to be evicted, which not only adds expenses for building owners but also reduces the property's income. Economic downturns generally exert downward pressure on demand, as illustrated by our demand line shifting to the left. Furthermore, during periods of economic prosperity, there's an inclination to construct more apartment buildings. Nevertheless, depending on the region, the time frame from conceptualizing a project to renting out apartment units can span from 12 to 24 months. This is precisely the situation at present, with an estimated 560,000 new apartment units entering the market in 2023, the highest figure in 2 decades. Most of these projects started construction in 2021 and 2022, times marked by more favorable economic forecasts. The surge in supply shifts our supply line to the right, resulting in a lower equilibrium price point where supply and demand intersect. While this example specifically relates to apartment buildings, Barry Sternlicht's focus extends to 2 specific real estate asset classes. The first is office buildings. Here's Sternlicht discussing how the rise of remote work is expected to impact the office market. Remote work. The overwhelming majority of office workers are not inclined to spend the entire workweek in a traditional office setting. This shift in work preferences is severely impacting the office real estate market, as companies no longer require as much office space as they did in the past. The situation has become so challenging that many office buildings, once bustling with employees, are now faced with the prospect of remaining completely vacant, with no viable option other than demolition. To illustrate this point, consider the case of San Francisco. As indicated in the chart provided, the vacancy rates in the city have surged to nearly 30%. This means that approximately 30% of all office space in San Francisco currently stands unoccupied. It's important to note that not all office buildings are experiencing the same degree of impact. Office spaces are typically categorized into 3 classes, based on various factors such as the building's age, location, quality, and amenities. These categories are denoted as A, B, or C class, with A representing the highest quality and C the lowest. Demand for premium A-class office space remains robust, as companies mandating their employees return to the office seek to provide a pleasant working environment. The challenges in the office real estate market are predominantly concentrated within the C-class office buildings. These buildings tend to be outdated and situated in less desirable areas. The outlook for C-class buildings is so bare that, in many instances, it would be more cost-effective for property owners to demolish these structures rather than continue maintaining and operating empty office spaces. Another area of concern within the real estate market is single-family houses. Starwood, the firm founded by Barry Sternlicht, possesses a portfolio of over 3,200 single-family houses across the country. He is closely monitoring developments in the housing market. Housing affordability in the United States has plummeted to levels near historic lows. This chart, courtesy of Goldman Sachs, presents a home affordability index spanning more than 25 years. The lower the index number, the less attainable it becomes for the average American to purchase a home. These metrics are a significant factor causing concern that the U.S. housing market might be experiencing a bubble. There are two primary reasons for the reduced affordability of homes. The most evident reason is the substantial surge in home prices nationwide. In June of this year, the median selling price of a home in the U.S. reached an astonishing $416,000, a notable contrast to $315,000 in June 2018. Nevertheless, the escalation in home prices only accounts for part of the equation. Perhaps an even more substantial factor making homeownership increasingly unattainable for the average American is the recent uptick in interest rates. At the beginning of 2021, the average interest rate for the standard 30-year fixed-rate mortgage stood at 2.65%. Since then, this rate has climbed to as high as 7%. This substantial surge in interest rates has significantly elevated the costs associated with buying a home using a mortgage. To illustrate this point, consider the following scenario: a $400,000 30-year mortgage with a 2% interest rate results in a monthly payment of $1,478. However, if we maintain all other factors and increase the interest rate to 7%, the monthly payment skyrockets to $2,661. Despite the loan amount remaining unchanged, the higher interest rate has led to an 80% increase in the monthly payment. One might expect these elevated interest rates to cause a substantial decline in home prices. However, this has not been the case. Individuals who purchased homes when interest rates were low are now grappling with a phenomenon known as golden handcuffs. They are hesitant to list their current properties for sale because selling would require them to forfeit their lower interest rates. This shortage in available houses for sale is artificially suppressing supply, leading to continued price escalation. To sum up, the future of the real estate market remains uncertain, and only time will reveal the outcome. Sternlicht anticipates a challenging period over the next 12 to 18 months for many people. Nevertheless, there may be a silver lining, as he has used the phrase "survive till 2025." This implies that for those who can weather the economic storm until 2025, there could be promising opportunities on the horizon. It's crucial to emphasize that the real estate market is delicate, and various factors may impact its future performance. It is impossible to definitively foresee whether there will be an impending challenge in the real estate market. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.